Welcome to FinTech Confidential, bringing you the people, tech, and companies that change how you pay and get paid. In this episode, we're thrilled to chat with a returning guest, Jordan Olivas, the founder of Harvv, a fast-growing B2B accounts receivables financing platform.
I've known you for a while, Ted, and one thing I've always harped on is payments should be an afterthought. If you can do that, you're going to be very successful. Payments should never be thought about. No one should know about payments. Frictionless throughout the entire journey, and that's what we're aiming for. We work a lot in the commodity space, meaning that there could be 10 other providers for literally the exact same thing that you're offering, like down to the SKU level. So how do you differentiate? Customer service, we've been here forever, and especially the businesses that have been around for a long time will say, I've never had someone default, right? That's my favorite thing to hear. How many times have your customers paid late and have you almost missed your payroll? How often does that happen? How many times have you been stressed in that situation? How many times have you had to turn down a deal from a Fortune 500 company? You may say, oh, it's because we don't want to do business with people like that, but that's not it. You want to be paid on time, and those companies don't pay on time. When you look at factoring, why is it that I, as a seller, offer my clients terms, yet I am responsible for their repayment? The factoring company should be looking at the buying side, not the selling side, for creditworthiness, right? Just the same way it does in consumer. It makes no sense. We've kind of coined the term, I think, about the domain name factor now, pay later, which is a bit cheesy, but I think it's the point across, right? We are factoring, but it's not set up like traditional factoring. And so sometimes with the older businesses, we will say, yeah, it's a new form of factoring. And that's, for some of them, that's the trigger that we need. I think the biggest changes that we're going to see in our economy as a whole is the scale of blue collar tech. Why? Because they're paid well. There's a lack of resources in those industries. And I think with that, you're going to have a lot of kids that are taking over their parents' businesses, right, as they look to retire. Because these parents aren't retiring, right? They're continuing to work, but they're letting the kids start to take over. And we're seeing that more as a macro trend rather than specific to payments. And so what we're doing is saying, look, you want to help modernize that business. You're going to scale. What are you going to do? Just keep hiring 15 Carols as you scale? No, absolutely not. So we want to make it as easy as we can for them. Just realize that your failures don't define you, and that the best thing you can do is to just keep going.
Hey, Tedd Huff here. Ever thought about how you could streamline your application and underwriting process? Well, let me introduce you to Under. Why keep using the outdated methods of PDFs when you can digitize them effortlessly? All you gotta do is upload the PDF, send it out for digital signature, and voila, you're set for the digital age. Are you curious on how to make that happen? Head over to under.io/FTC and get started for free. It's really that simple. Welcome to FinTech Confidential series Leaders One-on-One, where we sit down with FinTech leaders to learn about what drives their passion for and their life stories, leadership, and guidance. In this episode, we're thrilled to chat with a returning guest, Jordan Olivas, the founder of Harvv, a fast-growing B2B accounts receivables financing platform that is making waves in traditional industries like raw materials, solar, construction, and consumer packaged goods. Now, Jordan is no stranger to entrepreneurship. Before Harvv, he co-founded KissPay, by the way, that's what he was on last time for, which rapidly became one of Asia's largest buy now, pay later services. His journey in corporate roles with major fintech players like Klarna and ChargeAfter are where he developed a deep expertise in lending, revenue growth, and strategic partnerships. Jordan's drive for financial innovation is clearly evident in his transition from consumer BNPL to B2B accounts receivables financing. This addresses the unique challenges faced by traditional industries. His leadership has led to partnerships with over 1,000 brands, including global giants like Samsung and Lenovo. Today, we'll be diving deeper into Jordan's inspiring journey, explore how he's reshaping B2B accounts receivables financing, and learn more about the impact that Harvv is making in the industries it serves. So let's go ahead and get started and welcome Jordan Olivas to the show. Welcome, Jordan.
Ted, thanks for having me. You always make me sound more impressive than I really am, so I appreciate the intro. But glad to be here again. Always happy to chat with you and talk a bit more about payments and fintech. It's a passion of mine. So glad to be here.
Last time you were on, we were talking all about BNPL in Asia and how that was different than the US and how you were growing that. And that was wildly successful. Now you've transitioned over into B2B financing here in the US. Give us a little bit of background on what inspired you to transition over to Harvv and the B2B financing area.
When you work in emerging markets, it's an absolute blast. And to be honest, I love doing business there. But the ground reality is, sometimes in emerging markets, when they block your ability to move money outside of the country, it kind of limits your business model as, someone who's providing financing. So when that happened, we'd scaled in 6 months to a couple thousand merchants. We were processing, millions of dollars every month. And we just looked at it and said, look, we need to move into a market that's a little bit more stable for the moment. And we'll go back to emerging markets. But we looked at this and said, look, the consumer market is completely saturated. It really is. But at the end of the day, what we really enjoyed about it was that for the B2B market in the US is that we saw a lot of players like really attacking the e-com side, but we really didn't find a lot of people going after, what built America, which is construction, raw materials, consumer packaged goods, power sports, which is turning into a great industry for us. We said, I think there is an opportunity here to provide some sort of fintech solution. And luckily enough, and within about a month or two of us launching a pilot, found out it was the right choice.
You're talking about all these opportunities with the buy now, pay later areas and then transition it over to the accounts receivable financing. What are some of the main challenges that during this process that you ran into that maybe you weren't expecting?
I think the largest problem that we see is that a lot of these industries are, they've been around 30, 40, 50, 60 years. And in e-com, you never really ran into that, right? People are always very progressive and willing to try out new things. And that's why BNPL did so well on the consumer end. But in this space, we almost have to find businesses that haven't been in business for more than 7, 8 years. Because right away, and to give a bit more context, we're providing a service where you can send out an invoice. We will allow you to offer, card acceptance, so Visa, MasterCard, Discover, Amex, all that good stuff, ACH, and then provide net 30, net 60, net 90 terms so that you are paid upfront with no liability of non-payment or late payment, and then the buyer pays back over time. So when you're talking to some of these companies, they've been around for forever. So they're just very stuck in their ways of no one ever asked me for net 90 terms. Of course not. Right? As you know, right, in the consumer world, very few people are going to ask, hey, do you offer financing? No, you've got to put the banners up. You've got to have your sales reps tell them, hey, we offer financing. And as everyone knows, right, that's been in the payments or financing space, you offer financing, you're going to sell more frequently, and your customer retention is going to go up. So a lot of it's an education game for some of these brands. But I'll tell you, once they get a hold of it, their sales reps just love the heck out of it. No questions asked.
One of the things that makes me think about it is when I'm shopping online and e-commerce and I get to the checkout, that's where I get told, hey, you can do the pay in 4, right? The traditional pay in 4 that we all know and love, maybe? I don't know. But
I'm a bit biased. But
with I'm wondering how is this process different? Because I can only imagine that it's not just going to be the buyer that's initiating the request to finance, but there may be also the seller saying, hey, this is something that you may want to look at because your order is bigger than normal. You may want to look at financing this. Help me understand how it's different, but yet a little bit the same.
The buyers on the other end behind those business entities are consumers, right? The psychology is exactly the same. The process itself is different, yes, but the actual underlying methodology is the same. Putting a banner on your website, putting in the footer of your email, right? Doing a couple of email blasts every few months, reminding your customers that you offer this. But where we really differentiate is that we insert ourselves into the invoicing flow. Solution A, use our platform, send out all your invoices through our platform. We can give your customers better rates, higher limits, because we have first-party data acquisition. If not, you can use our platform if you're connected with Odoo or QuickBooks, right? We insert ourselves into that invoice to let your customers know that you're offering financing. And it's a very small thing. And a lot of times customers say, well, I don't really know if I want to push you all that much. I said, well, do you want to make more sales? Try it for 30 days. If you hate it, get rid of it. But I feel confident that 30 days that it's going to be a result. And the great thing is, because I've done this for so long, and now I know what they're going to say. I've actually read my emails that say, and before you say no, here are your most common things that are probably top of your mind, X, Y, Z, right? And our conversion right now from opportunity to close is almost 17%, which is unreal, right? For most sales orgs.
So I mean, you hinted towards this. Of course, now I'm going to ask, what is X, Y, and Z that you know is always going to come up?
We have some of the most aggressive rates in the industry, right? And the reason we are able to do that is because we focus on traditional industries. We're not really focused on e-com. We can do e-com, right? If someone has a closed loop marketplace, works well for us, but we're focused on traditional industries. So we're not blending the high risk of an open loop marketplace when anybody can just go on and select financing. So our rates come down. So we say, but your rates are still higher than I get a loan. It's like, well, this isn't a loan. For you as a seller, it is a sales tool. If you go off and got a loan to give your customers net 30, net 60, net 90 terms, one, I don't think you would do it for net 60 and 90, except by exception, net 30 at the most. You would be held liable if your customers are late or if they don't pay at all. So this is not a financing tool. And second to that, which I think is the most common, well, I don't know if I want to give this to all my customers, just select few. I say, everybody says that. First month or two will be about 15% of your total GMV. In about 3 months, we're going to be about 70%. Why? Because you're going to see the numbers and they're going to work. And so there's obviously plenty others, but yeah, those are some of the most common that we see.
Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how. I'm looking at the markets that you chose, right? So your solar, consumer packaged goods, other hard goods. What was the thought process of going down that? And what was the market strategy that you're really looking at when going that direction?
When I was at Klarna, one of the big problems that we had, I was always trying to sell into the CFO and never made any progress. That's when I figured out the target market is not the CFO, it's the CMO, right? The one managing the e-com, VP of e-com, right? It's a marketing tool, it's a sales tool. Well, what's different about these industries, right, is they don't typically have a marketing team. Maybe one person sitting in the back office, right, trying to do multiple things, right? But most of these B2B companies don't have that. What they do have is direct sales teams. So when we go after these companies, we go after the VP of sales, the CRO, many times the CEO if they were a salesperson before. That strategy of going after the person who's chasing the revenue and giving them tools to sell more is really the core of our strategy. Once again, this is not a financing tool. And that's, I think, a lot of the problems with the way these people see. I'll talk to a VP of sales. Oh, I'm not really in charge of that. I said, look, I know you're going to try to pass me to your CFO. This isn't a financing tool, right? Like, so let's not go there. Like, you can bring him in if you want, but he's going to tell you no. He's going to say it's too expensive, blah, blah, blah. And guess what? Nothing's going to get implemented. You're not going to sell more. It's too risky. They're not a bank. They don't have this license. It's like, guy, like, that's not a thing. So we really do focus on the person driving revenue and help them understand. You go into any store that sells financing. The sales rep of the store is not a financing person. It's a sales rep, right? You go into Best Buy, you go into Harvv, you go to any place that has financing in store. It's the sales rep that's pushing it, not the finance team. Why? Because it drives sales. It's not a financing tool.
You know, as we look at this, you mentioned that it's not a loan product. It doesn't fall into a lot of the traditional categories that people would think of. How have you leveraged technology to optimize these business processes? You mentioned a couple integrations, but one of the key things that I'm hearing is really you're leveraging this technology to drive cash flow. Can you help us understand how you're using technology to increase the cash flow outside of just making it available? I
think one of the hardest problems that we've seen is when you look at other companies that are in a similar space is that the onboarding is always ruling. Even for us, I'm not happy where our onboarding is at. There's always more that could be done. But I say about 70% of our efforts are done on onboarding, right? So that starts with, we have really easy to use QuickBooks integration, really easy to use Odoo integration. Right now we're working on other accounting platforms. Why? Because when someone comes in, we want them to be able to click a button, sign up with QuickBooks, be instantly onboarded, right? So that when sales reps are going out, the reps may not even know about it. They're gonna be like, hey, my customer is asking me about this finance thing they got in their invoice. What is this, right? If we can get to that level, that's where we want to be. So by simply going out there and taking an e-com approach of creating plugins and not making a super manual process of having to request approval every single time, taking 3 days to get approved from another company. No, you come in, you send an invoice, the customer applies, it reconciles back to your books, you're done. Simple as that. I've known you for a while, Ted, and one thing I've always harped on is payments should be an afterthought. If you can do that, you're going to be very successful. Payments should never be thought about. No one should know about payments, frictionless throughout the entire journey. And that's what we're aiming for.
It's interesting you bring that up. I was on a payment facilitation panel at the MPC conference. One of the things that I kept pressing really, really hard for a lot of people to understand is the payment transaction is not the end goal. It is the trigger for all the other value you can provide. And it sounds like you've magnified that piece of it. Not only that, but you've done a lot of automation around it. Can you dive a little bit deeper into the automation and the services that you're providing really to support those CFOs that feel like it might be too expensive or it may not fit the bill for them? How are you using those sorts of things like automation to win over the accounting team at these businesses?
Well, of course, we're going to want to say, hey, send out marketing campaigns. Hey, put a banner on your website, right? That's actually the hardest part of the sale. These companies don't have those resources in-house. So how do we get that automation? Once that comes in, someone makes a payment. In your journal entry, it doesn't look any different. All it says, hey, this payment was paid via Harvv instead of via cash, check, ACH, whatever. We send one payment, one reconciliation file. If anything, it should be easier because now you're not receiving 100 different ACHs, right, for different transactions. You get one file with one payment, nice and easy. And recently we signed an agreement and a partnership agreement with Rainforest. So we can start offering card acceptance within our solution as well, right? And the real benefit of that was that it was amazing how many B2B companies did not offer cards. If they did, they hated offering because it was super manual for them. They'd take it over the phone, which is a PCI risk. They had to pay the fees, they had to add as a line item. For us, my product team to me said, well, what can we do to make this better than just any other payment processing? Simple. Give them the button, which says pass fee to company. That's it. So now if you don't, because a lot of B2B transactions have low margins. If they want to pay via card, we say, great. Now just click a button, a toggle switch, adds the fee, a 3% fee to the invoice, and then you're done, right? No 2.9 plus a flat fee, no interchange plus, just flat 3%. Do you want to cover it? Do you want your customer to cover it? And that has been a huge positive receptor in our current ecosystem because for some reason that does not exist. I'm sure somebody's done it out there somewhere, but there's no one in the mainstream that actively does that as an option. And for good reason, because it affects conversion, right? If you add that line item there, plus you have the legal side of the card networks, right? But it's amazing how few platforms offer that today. And that's why we're really focused on those niche industries there.
So you mentioned cards. I'm assuming that you support other forms of payment. And I'm going to push a little bit here, but do you see or hear any of these B2B places asking about, and I'm going to use the air quotes, real-time payments? Is this something that they're looking forward to? Is this something that they're asking about? Or is it, hey, we just want to get the money when it's due? Help me understand the perspective from business to business clients.
I think even in the consumer world, very few companies are thinking about RTP, right? I mean, they are FedNow or really any of these other kind of new rails that are coming about. It's just not there, right? It's kind of like, if you're in the industry, of course you know about them, right? A lot of people listening to this will know what that is. But where we've done is we kind of said, look, if you're on one of our premium subscriptions, we can give you T+1. Getting the same day is maybe sometimes, right, is great. But we are looking at that as an offering, right? Hey, if we give you an accelerated payout, what does that look like? What does that mean? But I think that when you're talking about cash flow, our view is we want to get ahead of it. And you talk about getting payments up front. We had one prospect that came to us, said, well, I just need this for this one transaction. We're like, look, it's going to take a couple of days to onboard you, get you integrated. Not time-wise, but just it happened on a Friday, right? I can't remember what it was. Probably get you live Monday afternoon. And then your customer will come in and he's like, oh, I need it right now. So he came back I think it was like 3-4 weeks later, I was like, oh, I need to do it again. It's like, come on, like just prioritize getting this right. We say, look, if you work with someone like us, we're going to get you ahead of that whole situation, right? We're going to pay you in a few days. It's going to hit your bank account. So I think it's less of like RTP and more so, how do I avoid that situation where I'm stressing out at payroll, right? And that's really the issue that we're solving, because there's a lot of businesses that are profitable, at least on paper, but their AR is huge. There's one publicly traded company we reached out to recently, and their AR had grown like 4x since 2022. And we're like, we can solve that. Let's get ahead of it. Let's solve the problem before it's a problem. I think that's where a lot of businesses are focused at right now.
When you were just talking about the AR getting astronomically high and just continuing to grow, I'm assuming there's some hidden costs, hidden things when they decide to take on that in-house, that when they make the decision to make the unique case of a 60 or a net 90-day piece. Help me understand and the audience understand, what are some of the things that maybe you don't think about that are hidden costs that go along with doing that in-house versus leveraging a product like Harvv?
So I told you not preparing for this would be great, right? You kind of just came in and asked one of my favorite questions. One of my favorite slides that one of my investors have is like the hidden cost of in-house financing, right? People are going to come in and say, all right, well, I can get a bank loan for 15%. Right, which is fine. But guess what? Carol in the back office has been with us for 20 years, spends 20 hours of her week, calling upon clients, tracking it, right? It's not just the cost of capital. It's not just that, right? There's an operational cost and a relationship cost. So if someone comes to you and says, especially in this space, I'll tell you, we work a lot in the commodity space, meaning that there could be 10 other providers for literally the exact same thing that you're offering, like down to the SKU level. So how do you differentiate? Customer service, we've been here forever. And especially the businesses that have been around for a long time will say, I've never had someone default, right? That's my favorite thing to hear. I've never had anyone default. Like, okay, that's fine. How many times have your customers paid late and have you almost missed your payroll? How often does that happen? How many times have you been stressed in that situation? How many times have you had to turn down a deal from a Fortune 500 company? You may say, oh, it's because we don't want to do business with people like that, but that's not it. You want to be paid on time, and those companies don't pay on time. They'll agree to net 60 to you and you're going to get paid a net 120. Why? Because they can. Like, that's it. Like, do you really want to deal with that? Right? And so what's interesting, especially in CPG, I love CPG. Why? They offer 210 net 30, right? Get a 2% discount for paying within 10 days or pay in net 30. We tell them we'll charge you the same 2% that you would have given a discount. We'll pay you up front and they can pay it in 30 days. So we love those type of situations. And once again, that makes it hard. Sometimes they're so ingrained. Think about the other intangible costs that come along with doing something yourself. That's true of anything in business, not just payments.
For those of you who don't have CPG in your alphabet soup vernacular, that stands for consumer packaged goods. So just so you can add that to your alphabet soup going forward. As you talk about being able to do those sorts of things, what I've noticed in any type of accounts receivables financing, at least from my experience, and I've worked with a handful of products over the years that we've done something. Now, I'm going to use the nasty word that nobody likes me to use, in sort of some factoring model. Not only do we looked at the factoring, but we also required personal guarantees. We required like all these other different things that really tied the business into same situation really as doing it themselves. Help me understand, how you're different. I mean, I don't think you guys don't carry any sort of personal guarantees. I think that's what you said during our pre-call discussion. No personal guarantees and a whole bunch of other stuff. So I'll let you kind of just take it from there and explain how you were able to decide on that, why you're not factoring.
So factoring is a dirty word. And I think because this is how factoring usually works. I'm a business. I work with Costco, Walmart, right? Whole Foods, whoever, right? They agree to net 60, right? So I'm going to go to a factoring company. Factoring company say, all right, it's a $100,000 invoice. I'm going to give you an 80% advance rate. I mean, I'll give you $80,000 minus my 5 to 7% fee for like 45 days, right? Problems with this. Limitations. Using a few $100,000 at most. We go up to over $1 million. 1.5, maybe 2 in certain situations. 2, requires that personal guarantee. 3, this makes no sense. And this is what was really the main driver where I found what was the biggest problem in the industry was that when you look at factoring, why is it that I, as a seller, offer my clients terms, yet I am responsible for their repayment? The factoring company should be looking at the buying side, not the selling side, for creditworthiness, right? Just the same way it does in consumer. It makes no sense, right? And so when you go after that and you look, it's like, wow, like advance rate, crazy high fees, sellers responsible. No wonder people don't like factoring. Ironically, our agreements are a factoring agreement. Now we have a subsection, and I found really interesting, how a lot of people use it, is that it's what's known as a reverse factoring agreement, right? So we are underwriting the buyer, putting onus of repayment on the buyer, and that's what makes things really different. I don't think any modern fintech person, you said, go out and figure out a financing solution for B2B, would come out and say, come up with this advance rate thing. Like, it doesn't make any sense. It maybe 30 years ago, sure, but it doesn't make sense now. We've kind of coined the term, I think, about the domain name factor now, pay later, which is a bit cheesy, but I think it's the point across, right? We are factoring, but it's not set up like a traditional factoring. And so sometimes at the older businesses, we will say, yeah, it's a new form of factoring. And that's, for some of them, that's the trigger that we need.
Always, Jordan, as always, man, you're right on the edge of what you're delivering and how you're presenting it. And I love it every time. What I want to do is understand from you, I mean, obviously you have a vision that goes way beyond this right now. What trends do you see or foresee in the B2B financing sector? How is Harvv preparing for those future changes?
I think the biggest changes that we're going to see in our economy as a whole is the scale of blue collar tech. Why? Because they're paid well. There's a lack of resources in those industries. And I think with that, you're going to have a lot of like kids that are taking over their parents' businesses, right, as they look to retire, because these parents aren't retiring, right? They're continuing to work, but they're letting the kids start to take over. And we're seeing that more as like a macro trend rather than specific to payments. And so what we're doing is saying, look, we want to help modernize that business. You're going to scale. What are you going to do? Is keep hiring 15 Carols as you scale? No, absolutely not. So we want to make it as easy as we can for them to where it's just human nature, right? As our society progresses, we start to specialize more and more and more. And you've seen that throughout the ages, right? Especially as like a first world countries. I tell you, working in Asia gives you a different perspective on the world. It really does. And what you start to realize is that folks in developed countries specialize into the most nuanced things. The more specialized you can get, the better. And that's why we're so focused on like, we want to enable this accounts receivable automation. And not just saying that send out an invoice, collect the payment. No, what is it we can do? Turning AR as a whole into a sales tool rather than, hey, here's an AR tool that can make things easier for the accountant. No, we want this to be a driving force where this financing is your key strategy. Any large company, American Airlines, Hilton.
As default rates continue to rise and margins compress in lending, financial organizations are searching for solutions to combine that operational efficiency with innovation. Look no further, as LoanPro allows lenders to enhance their origination, servicing, collections, and payments using the foundation of a modern lending core. Check out loanpro.io to learn more about how over 600 financial organizations have modernized their tech stack with LoanPro.
Anybody with a consumer credit card, where do they make their money? It's not on the retail sales. Absolutely not. It's not on anything, right? It's on two things: loyalty, credit cards. And I think in these other industries where the margins are even smaller than retail, like electronic retail especially, I think you're going to see a lot of innovation come on this side. And that's what we're preparing for. Like, for example, we're rolling out a reward solution for sellers. We're going to give a point to the business. They can use it whenever they want. A point to the sales rep. They can use it whenever they want. And if a buyer hits a certain tier, we'll also start giving them reward points. Why is that important? Because they're consumers at the end of the day. And we want to incentivize them for using our platform, especially if they're going to fully adopt what we're doing as a whole. And I'm excited to see where that goes in the next few years.
So you hit on so many different areas there. What would you say is the number one place that you see the greatest opportunity for Harvv to really change the way accounts receivables are being treated today?
I think the biggest impact we can make is simply educating the folks that we're talking to about the importance of payments. And look, Ted, you and I probably talk about this for days, if not weeks or months, but payments are the most important thing in a transaction. Why? It's at the end of the funnel, and that's what triggers the recycle of every customer coming back and using you again. You can have 1 million site visitors every hour. It does not matter. If you have a 20% authorization rate or hell, even an 85% authorization rate. How much money you're leaving on the table? You spend all that money getting to the site, to your business as a whole. Go down the conversion process. You go through the red line of contracts if you're B2B, and then you don't close a deal because of something like that. I think that's the biggest impact we can bring, is bringing payments as a mechanism to close a deal to the forefront of salespeople's minds, to help them understand this is the number one way they can meet their quota. And I think if CEOs and CFOs realize that payments is not an accounting thing, it should be a larger business focus. Think about it. You go to a large brand, doesn't matter who it is, any large business, what do they have that every other small business doesn't have, or even medium-sized business doesn't have? Treasury department. What is the purpose of treasury? How do I extend my payment terms? How do I get more cash in from here? How can I make sure every single penny counts? Imagine having an automated treasury department in your business doing $5 million in revenue a year, $1 million revenue. Impressive. And that's where we want to be. We want to be that treasury department for them to help them optimize their cash flow, their customers' cash flow, and find new places to make money they never even thought about.
It's interesting you bring up treasury, as I spoke at the Midwest Acquirers Association earlier this year, and the whole panel was really focused on the opportunities in business to business payments. And one of the things that I wanted to make sure to share with the audience, it's not just about getting them a lower cost on their credit card payments. It's not about giving them a better technical solution. Although those are fantastic and that makes a lot of people happy, it's really, how do you make the team at the business more efficient throughout their entire treasury process, as you just mentioned. And one of the things that we brought up, and you just touched on a little bit, how do I increase the incoming cash flow and reduce my dependency on trade lines with my treasury at the financial institutions? And that's one of the things that I really harped on the team to really think about, is as they were going into it, how can I provide that kind of value? How do I help them look at things differently? What additional data should they be looking at, or how can we pull that in to really enhance that experience? Not always for the customer, because the customer, when they make that payment, that's fantastic. But how do we enhance the experience for the team, the comptroller, for the CFO, for the treasury person within the organization, if they're large enough to have that, to really reduce their day-to-day level of interaction with these pieces, so they could work on the exceptions, not the rule. And it sounds like that's really where Harvv is headed towards, really allowing those. When you look at the automations piece of it, I think you guys are tied into a handful. I can't remember, I was doing the research and I can't remember exactly how many now, but a handful of the ERP systems, a handful of the order acquisition softwares, to really bring that together. I'm going to go back just a little bit here, but what other ways are you making it easier for them to connect all of their systems, or all the data for their systems together?
I'm going to give a specific use case, which I really enjoy. And this one's power sports. So power sports, the ATVs, dirt bikes, stuff like that. We've got a number of, we've done really well on that side. We've signed a number of pretty large clientele there. And this was really interesting. So in power sports, you get something, just some like car dealers, you get something called a floor plan, right? I go and buy units. I put units on the floor plan. I get a really low rate for it. And when I sell units, they cycle off. I pay the interest. Problem solved. Now, here's the problem. Financial institutions that provide floor plans treat the floor plans as a loss leader. They use the loss leader in order to get into the consumer side. Here's the problem. Market takes a turn. Consumer buying power goes down. They pull back. And the way that they create these products at financial institutions, they bundle them together. So even though this one's really good, it's a loss leader, they pull out completely, right? Or they'll lower the line so badly that it's just not usable anymore. Here's the issue. If I went to any actuary, if I went to a data scientist and I said, go design me a B2B financing plan so that dealers can go buy more units, never in a million years will they come up with a floor plan. Why would I put an asset on a book? It turns in the next model year, and now my asset, which is brand new, never moved, has now decreased in value 25%. It doesn't make any sense. It's so risky. So what we've done is we said, we go to these dealers and we'll say, look, this is think of it as a new type of floor plan, right? It's a factoring agreement, but think about it as a new type of floor plan. And I said, well, what if after 90 days, could we do 30, 60, 90 delayed payments? What if 90 days I haven't sold the unit? I said, look, because at that point, it's a risk. This is the exact same reason why every 8 years, you have to go through a bunch of stress. And these financing companies are pulling out. Like, aren't you sick of doing that every year? And they're like, yeah, absolutely. So instead of that, pay us back on that unit. Go and buy tires. Go buy used units. Go buy oil, whatever you need, and change the way that you're managing your cash flow. Instead of tying it all up in units, right? Oh, it's just the way we've always done it, right? No, think differently, right? Pay that off. And now think about it. You've got this more comprehensive plan that's safer for us, safer for you, easier to use. And guess what? It creates more flexibility because floor plans cannot be used on oil, cannot be used on tires. New sales on ATVs are down between 3 and 6% last quarter. Consumer buying power down. What's up? Tire sales are up. Used units are up. Now we've given them a tool, right? To be able to do that because we've created that flexibility and thought about the long term instead of just being, this is the way we've always done it, right? As a financing company or as a business, been in business 20 years. And so I have a lot of respect for those businesses that have built their businesses that way, right? And if they want to keep the status quo, I'm not going to spend my energy trying to convince them otherwise. But they really do want to scale. They want to make things a little bit less stressful. That's where we want to come in. Sorry, that's a very long-winded answer, but that's how we're creating. That's how we're creating that technology, right? Of like, it's not just the technology of I'm connecting to your QuickBooks account. I'm connecting to your ERP. I'm connecting to all this, right? How do you bring all this data in? How do you analyze it? How do you use it actually in a practical sense, right? Go out and create a more effective business plan. And that's where we're coming into play.
It's interesting the way you describe that. Most people, when they think about risk management, they think about how is the consumer going to pull the wool over my eyes? How are they going to, how do I keep them from going in default? How do I do these things? But you just brought up a different place, which is the enterprise risk level that a lot of organizations, especially when they're on the smaller side, they don't really think about. And so being able to provide them that additional visibility into how to manage risk in other areas of their business is really unique and a really different way to bring that to the market. So I'm going to shift over because, as I mentioned in the intro, Jordan, this isn't your first rodeo in the entrepreneurial space. What I'm going to ask you to do, and I know it's a hard one, but in one sentence, what piece of advice would you give a budding entrepreneur, an existing entrepreneur, on how to consistently and continually bring quality, successful market products to the market?
Just realize that your failures don't define you, and that the best thing you can do is to just keep going. I talked to an investor last week, and I said, what are the top 2 reasons why the investments that failed? And his response boiled down to product market fit was not right, or the tech didn't do as well as he thought, or they gave up. Giving up too early is the number one failure for entrepreneurs. You got to fail a million times, and kiss pay hard. We've almost gone under like 15 times. It feels like, yeah, we're still here. It's amazing. I still I look and I'm like, how the hell how do we navigate that? Right. And we've brought, now this will be our 3rd profitable product to market very quickly. And I just like, it's once again, now you realize it's a process, right? Once you get the process down, like you can go into any industry. You can bring any product that you want to market, but realize that product's going to be different. Yeah. Just keep going. Don't stop. And it's very easy to let your failures define you, and it's don't let people do that to you.
So of course I'm going to ask this question. Can you share with us a time during this journey that you truly felt like it would be better if you just shut it all down? And then what did you do to keep going?
Well, outside of the multiple times I've cried in the shower alone, the amount of stress that I've been under, there's actually one particular time I remember we were going to miss payroll. I was like, this is it. Like, we're done. There's nothing else I can do. Like, doesn't matter how many sales I make. Like, I had 2 weeks, we're done, maybe. And I was like, how do I bring this up to people? And I, leveraged on my team really hard to help. But we got this one payment from a client that came in. I remember like going to my wife and just like sobbing. Like, I was just so relieved because I wasn't expecting this to come in. I thought it was just lost cause. And it was a decent enough payment. I was like, holy shit, we made it through that. And like, I thought it was done. And I just remember like sobbing at my wife. It was the most like humbling, unworldly experience I've ever had. I think at that point, I realized, I was like, if I made it through that, but that close, like everything else is easy. You start to realize, and since then we haven't really been like on the teetering of that. Like, we've had some things going up and down like most businesses, but like we've been on the up and up for a long time, and like it feels really good. Like things are going well, and I think that's where it boils down to. And I'll tell you, I've had multiple people. I've had investors tell me this, friends, family, advisors. Sometimes you just shut it down. Just shut it down, start fresh. And I was like, that's not in me, right? It's not dumb.
I was going to say, man, that doesn't seem to be in your DNA.
No. That's how you get people to back you, right? It's just that tenacity. So it's if you're an entrepreneur, just keep going. Just don't let, and everyone's going to tell you why you can't do it. And you already, think about it. If you get funded, you're like a fraction of a percent of that winner. Like if you fail one time, who cares? Do it again and again. Like, just don't stop. And realize that you can't do it all. You can't. Like, you gotta find a good team. If you don't have a good team, nothing's gonna matter. I'll tell you, my team that I have right now, best of the best, just fantastic. Like, I love those. I love my team. Like, they are really good at what they do. They're supportive, and it's just life is good. Life is good. I can't complain.
Well, Jordan, we've covered so much stuff today. I mean, we talked about the market, we talked about Harvv, we talked about differentiation, we've talked about your unwavering tenacity. Is there anything that you want to share that maybe we haven't covered today?
Yeah, if you haven't already, please be sure to like and subscribe to FinTech Confidential. give this podcast a share. LinkedIn, X, Facebook, Instagram, and wherever else you like to social. And Tedd, it's been awesome. Always good chatting.
Well, Jordan, thanks again, man. I'm happy to have you on again, especially with your newest venture here in the United States with such a revolutionary approach to a long-lasting problem. So thank you again for being on. Folks, that's a wrap. That's another episode of FinTech Confidential, Leaders One-on-One. And as Jordan said, if you've made it this far, go ahead and like, subscribe, share. We drop knowledge like this all the time, and you'll be notified by going to access.fintechconfidential.com. It'll get you signed up to be notified every time a new episode launches. And of course, follow us on LinkedIn, where you get to see all of the great stuff happening. And as always, keep moving forward. As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, you know it's a complex battlefield. That's where Hawk's AI tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords, they're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to gethawkai.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media, with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.